I lost everything in 08.
The housing market is rock solid.
It's a time bomb.
We currently have about $140 million under management. We consistently raise between 12 and 17 million a year pretty easily. The typical return for our investors is about a 25% IRR. You're getting your hundy back plus a hundy.
How do I know if I throw money to you, you're not whacking me on the construction?
I get paid more if I make you more. There's good debt and there's bad debt.
Not according to Dave Ramsey.
Don't get me started on that guy, man. You look at what Elon did when he bought Twitter. He just leveraged his stocks. He still owns the stock and he owns Twitter. BlackRock scooping up houses left and right. They know you need a house. They know everybody needs a house and people will pay for that. We have about a 4.5 million house shortage in America right now. It's going to take 8 or 9 years till we have a supply that is equal to or greater. And until that happens, you're going to have a constant demand for it. Making money's not hard. It's knowing what to do with it so that it does something that doesn't need your time right now.
What do you think the initial lump sum of somebody to get into real estate would be? What it is, Brad Lee back again with another episode of Dropping Bombs. Listen, if you guys like money, pay attention, pull over your cars, stop the treadmill, get out your pen and your paper, especially if you like recurring revenue, tax advantages, and real estate, because today's guest is Shannon Robnett. What's happening?
Not much, Brad. Thanks for having me.
Now, folks, if you guys want to follow him, and I know you're going to, at Shannon Ray Robnett. Robnett is R-O-B-N-E-T-T. R-O-B-N-E-T-T. This dude's been in real estate for over 35 years, helps investors and business owners, develops multifamily, industrial, shows people how to legally not pay taxes through all the various loopholes that are set up for rich developers and investors and real estate moguls. You know, he's been doing it for 100 years, knows everything there is to do it. And basically, you know, Robnett's rundown that gives real estate education and investor tips. Is that a podcast?
Yeah.
You got your own?
Yeah.
How long you been doing that?
About 2.5 years.
Oh, shit. So you're legit.
Well, I guess if that makes me legit, Brad,
Well, dude,
I'm legit.
well,
I've been building for 35 years, but I've got a podcast now, so I'm legit.
Yeah, but podcasters, no. The podcast is legit.
Yeah.
Because a lot of people, they say, I got a podcast. I go, oh, how long you been doing it? You know, nine weeks. You know, how many episodes you got? 4? It's like, dude, you got to get to like 50 or 100 before you're legit.
Yeah.
No, real estate, you're already legit. How much real estate knowledge do you possess over 35 years?
Well, you know, I've done everything wrong. I've already got that out of the way, you know, and I didn't go to college. You know, I thought I was going to go do something different, but I wound up back in doing what my dad did, doing what my mom did, and really saw where the advantage of that was about building that reoccurring wealth. You know, my parents retired when they were 50 and they're making more money now than when they retired because the assets keep appreciating and the rents keep going up. And just seeing how you can create something once that pays forever and the person that's in it is the one paying off the bank for you. I mean, you know, the thing is there's not that many moving parts. It's not like your business. It's not something that the landscape is changing every 6 weeks. It's the same stuff. You know, we're still building houses the same way we did 50 years ago. A little bit more energy efficient, but it's still the same stuff.
You think that's going to change?
I think, you know, some of that's going to change, but it's definitely not going to get automated.
I saw recently where someone 3D printed a house.
Sure. Have you seen it? It looks like something out of Star Wars. You want to live there with your Ewok family? You know?
Well, maybe not today, but dude, pretty soon, maybe there's just a whole Ewok neighborhood.
Yeah. Yeah. And, you know, that kind of stuff is happening, but it's, you know, I don't know how they're going to print a house you want to live in for that kind of money. You know, I just don't know. I don't see that happening.
I didn't think they'd make container homes I'd want to live in, but I've been seeing some lately like, damn, that's a badass house all made out of containers.
Yeah. Yeah. And, you know, I mean, if you spend enough money, you can convert anything, you know.
What do you build?
We do multifamily and industrial is kind of our bread and butter. That's really what we're good at.
Now, my team doing a little research says you've made over $425 million in projects.
That's just purchases and sales. Yeah. Projects that we built, stuff like that.
So what is your goal?
To die with an LOI in my pocket, man. I mean, I want to be chasing a deal when the gravedigger comes for me. You know,
are you
Why not?
addicted to the deal?
I love it, man. That is the deal. I mean, look, putting it together, knowing that you have got all of the channels covered, the bank's on board, the city's on board, the permits are ready, the thing goes off. Dude, that's better than anything else out there, man.
So my question to developers and people like you has always been, why are you raising money? Why don't you just use your own?
Well, I did for a long time. I didn't start raising capital until 2019. And I just, I kind of found myself in a place probably like Charlie Sheen did. I just needed more, But I mean, when you're doing an $80 million apartment and you need, $17, $18 million in cash, I don't want to stick all my eggs in one basket because I got 4 other irons in the fire that are going to go off every other year. And so it got easy because I have the system very much like you do, where people can deploy capital, not have to go be a landlord, not have to worry about somebody flooding the tub on the 3rd floor. I've got all the systems to take care of that, and people are able to utilize that for a return for them, tax advantages for them, and we take care of all the dirty work, and that's the part that I like doing, is putting the deals together. So it kind of feeds both sides.
Yeah, but to me, if I have all that, the only reason I take money is because I want to do more than I can do on my own.
Right.
Meaning all my money's deployed. I don't have any more. I'm maxed out financially on all the shit I'm building. So yeah, I'll take your money so we can do a 5th one or a 10th one or whatever. And then when these pay off or start to, and I get that chunk back, I'm going to redeploy that.
100%. I sold an apartment complex in 22. $10 million lasted in my account for 16 months. It's all deployed, but I put 5% of my own, or I put 5% capital in every single deal. So if we're raising $10 million, I'm putting $500,000 of my own money in. Plus I've done all the planning at cost. I've done, all the earnest monies. It's not hard, Brad, to get $1 million, $1.5 million out just in earnest monies.
Plus you are the GC too.
Yeah.
So you're making money there.
We GC a lot of projects, and it's
how do I know if I throw money to you, you're not whacking me on the construction?
Because I make more money on the development once it's up and running and we're pulling cash off of it than I do building it. I mean, look, there's about a 6% profit margin in being a general contractor, right? So we currently have about 60 million going. So we'll pull about 3 million into the company this year, right? That's not bad. You can live on it. But the better money is made when the property's up and running and it appraises for $80 million. We built it for 65, and then we're putting loans on it. And we're pulling everybody's cash back out of it. 60, 70, 80% of the cash that's in it is coming back out. We're doing another deal.
Does everybody just keep their money with you?
We have about a 98% reinvest rate.
Because why would anyone ever take their money out?
I don't know. We haven't had that problem.
Unless they needed it for something.
Yeah, but most people, I mean, this isn't their last dollar. It's not their first one.
So was there a point where you didn't have money?
Yeah.
Did your parents teach you and give you the start?
My parents, when I told my parents I wanted to go build houses because I was going to college, I was going to be one of those smart college guys, and I was going to college, and my brother right out of high school was building houses. And I mean, he'd build 4 a year. He was making about $58,000 in 95. That was some good money back then for a kid right out of high school.
Yeah.
And so I went to go build houses, and the first thing my dad said was, well, let's go get the backhoe. We had to go dig the hole and pour the concrete and frame the house. I mean, we literally built the house. I mean,
with your hands.
Yeah. I mean, my brother and I had 2 framers that we shared back and forth. And, you could make $9-10 on a house, take you 3 months to build,
How much was the house?
We were selling for $79,900.
So $80,000.
$80,000. Yeah. Yeah.
What are the houses you build now for?
That same house is 4.5 now, $450,000, but, that's okay. I just don't like homeowners. Oh, there's a nick in my baseboard over here. That light's a little bit crooked. And you're dealing with one-offs. I don't want to deal with 200 people on a walkthrough. I want to deal with 200 tenants that if I don't like you, I don't renew your lease and I raise the rent and the next guy comes in. It's a whole different mindset. I've got a property management team that takes care of all of that.
Do you build them and hold them, or do you build them and sell them? We've
sold a lot of things over the last couple of years because COVID pricing was really, really great. We hit 10-year investment returns in 30 months, and because I'm not waiting on the retail market to bring me another apartment, like you mentioned, Grant is only able to buy what's for sale. I just go make another one, So for me to find another piece of land, get it entitled and build something else, that's not hard.
You got all the workers?
Yeah. Yeah. I've got subcontractors I've used for 15 years. Same guys.
Do they go all over the United States?
We can. Yeah. I mean, we're finishing up a building in Florida right now.
Yeah. But
we use local subcontractors.
What about the Montana deal?
Oh, well, we'd hire local people up there. We need to know people that know how to work in the 6 foot of snow.
Well, that's another thing I didn't anticipate or think about. Winter comes.
There's certain stages of the game that you do that allow you to get to a point where you're now working inside during the winter. So we work out. I mean, you plan for that and you build all year round. It's not like Vegas here where they like working in the winter because it's cool enough to work outside.
But I mean, I when it gets to be frozen Tundraville, like Vail or Aspen, how do you build something when it snows most of the year?
Well, a lot of that is you'll panelize a lot of that. So the wall panels will show up built. You'd go in and put in all your foundation and get your wall panels up, and then you're inside doing plumbing and electrical and all of that stuff inside during the winter. So it's just the way you just systematize it,
So you know how to build shit from top to bottom.
Yeah. Yeah. I mean,
yourself.
Yeah. Yeah.
See, it's not I wish I would have gotten into that because dude, to me, that's what's scary. Like I hire you. I don't know how bad you're dicking me.
Oh, well, that's easy. We just run open books. I mean, you're more than welcome to check it anytime. I mean,
yeah, but how do I know that you say even rebuilding the studio, guy comes in, charges me, I think $6,000 to hang that. The dude that came in to hang this said, I'd have hung that for $2,000. Well, did I get rooked? And how badly can you get rooked in the GC world?
Well, I mean, there's a lot of that. Sure, you can have that happen, but where I'm also an investor in the deal and I make money based on you making money, if I screw you on the construction, I'm not making as much on the other side.
Well, I ain't talking about you. I'm talking about GCs in general.
Yeah. I mean, there's a lot of that that's, the normal GC world is they come in and everybody submits the lowest bid they can possibly do it, and then they do change orders from there on out. The problem with that is when you're building a $65 million apartment complex, you've got to know your numbers before you start drawing your plans. And so we always do a design build. Look, nobody knows better how to do it than the plumber. I don't need some engineer that went to school to tell me I need these fancy French toilets. I need my plumber to tell me he can do it for $1,200 a fixture and do it all day long for that. So he gets involved from the very beginning because cost is, if you're 5% off on 60 million, you're off a bit. We've got to make sure we're not making those things happen. So we start that with the design build at the very beginning so the plans come out right and there's not a bunch of change orders at the end. We just don't do change orders.
What about down to the doorknob cost?
Yeah. I mean, I know all
that doorknob versus that doorknob times 100 doorknobs, starts to add up.
Yeah. I mean, there's 9 doors in an apartment, right? I got that times 200. That's 1,800, that's a few doorknobs. You got to make sure you got your stuff,
So I would just assume, because you've been doing it so long.
Yeah.
You have software and shit that tracks it.
Oh yeah. I mean, I've got a guy that's all he does is take plans apart and make sure we're accounted for every single piece of every single thing,
So where does it go wrong? How do you get over budget?
Typically in timing, if you're not paying attention to your schedule, my interest on the current project we got going right now, it's about $7,000 a day, So if you're not paying attention to your schedule and you get 90, 120 days late, You just racked up a big chunk of money that you hadn't accounted for. And cheaper isn't always better. Your guy that might have hung that screen for $2,000 might have took a week and a half. Well, then now you're losing money, right? So you've got to balance that. And a lot of the things that we do is, in the general contracting world, there's a time when you've got to a point where you're going to be 60 days from the time you start a work till the time you get paid. Well, that takes a lot of the littler guys out that'll do it for less. So we always keep cash on hand so that we can pay at milestones. So you're getting paid every 2 weeks. So you can come in with a really good company that can handle the project, and we're going to take care of that, and we're going to negotiate in a discount. So now we're going to be able to get the product done on time. We're going to get it for less. And, you run into economies like now, we're paying for stuff up front. We're getting deals on stuff. We're about $250,000 a building right now under budget on stuff, and we're running the schedule just fine. But you got to make sure you know that stuff.
Well, that is very difficult to learn in a year.
You learn from doing it wrong, right? I mean, I don't know how you learned your stuff, Brad, but I don't think it was by doing everything perfect every single time, right? Mm-hmm. You learn that the ones that cost you money are the lessons you remember the most. And after 35 years, we've hit most of those milestones of learning that lesson, and we're not repeating those mistakes, hopefully.
Robnet's rundown is gaining traction. I'm reading my notes.
Yeah.
But what made you start a podcast?
There's a huge gap between what I know and what somebody needs to know to get started, and the problem that I found with a lot of people is they don't really start paying attention to other sources or other streams of income or how to pay less taxes until they start to get to the point where they're writing checks with threes or where they're writing checks with 6 zeros in it. You got to write a check with 6 zeros in it. You all of a sudden are paying attention because a major portion of what you could have is going out the door. And I really wanted to make sure that other people could understand how to get started small, how to find people that are qualified in the field that they want to do business in and chase that down and get a piece of the American dream, because corporate's not going to give it to you. Man, they're telling you to, invest.
Better pay attention to that one.
Well, it's not. I mean, Brad, do you know anybody that has been even remotely as successful as you that has gone the corporate route?
No.
Okay.
Well, some of them, but they quit the corporate route and then went out and built something.
So what they did was they went to college while somebody else paid them. They went corporate, and corporate taught them how to do it, right? I mean, people ask me this all the time. If you could go back and tell your 20-year-old self what to do, I would tell myself to go get a job for a developer and not take 35 years to get where I'm at. I could have done it in 10 if I'd have gone to work for somebody else and figured out their system and then just done the old R&D where you rip off and duplicate. You don't have to do everything yourself. I mean, if you need a open heart surgery, you're not going to go to college for 4 years to learn how to do it so you could save the money and do it yourself. You're going to go find a specialist that does that.
Yeah.
And that's where I think we were trying to really find the ability to create value for people that they could then have a way to learn this stuff and understand what we do so that they could feel comfortable in a partnership type situation or getting into a world that wasn't what they were used to or they weren't comfortable with. Because I see a lot of people, they go out and they want a house hack, or they want to fix and flip, or they want a wholesale.
What's house hack?
House hack's where you buy a duplex or a fourplex and you move into one unit because you can get a almost zero down loan, and then you become a landlord. Being a landlord sucks, man. I mean, I don't do it. I have to hire people to do it because I can't stand them, right? But the reality is I had to go learn that, and I had to get that call at 2:00 in the morning about the busted sprinkler line or the fact that somebody backed through a garage door drunk or all these stupid things. And I had to pay that price, but you don't have to, And by being able to give people that information, it can shortcut how they get to where they need to go.
Well, take a guy like me. I got some dough.
Right.
But I have zero experience. I just throw my dough to you.
Well, No, the first thing I'm going to teach you how to do is how to basically underwrite a deal so that what you're throwing your dough at isn't just out the window. I mean, you have to understand the basics, but what's a good ROI? How can it be tax advantaged for you? How can you master the system very quickly? And then, yeah, I'd love it if you partner with me or someone like me. There's multiple people that do what we do, not to the ground up development part as much, but you can still have access to people like that, and you can get in with good people that are going to help you get good returns.
I know, but I did one, and I got $160 a month.
Because you didn't do your underwriting. I'm just telling you, man, because if you'd have read the material and you'd have saw that's what you were going to get, you wouldn't have invested in it.
Well, I would have that. Just to,
sure.
That was to alleviate the pressure. but again, other people, they put a bunch more into that, and that's essentially what they're getting. He didn't single me out. This is what you're getting. This is what everyone's getting.
Right.
So, and again, I always knew this, but he's making all the money.
Right.
Okay. Well, I want to be able to figure out who's the dude where I get in and I'm making my pro rata share of the project.
And that's how that's really what understanding how the deal gets put together, how the sausage is made, right? I mean, if you're looking at it, there's a lot of people out there that syndicate deals that they'll come in and they'll be the general partner. They put no money in the deal, and it doesn't matter how good or bad the deal goes, they're going to get 30% of the profit. Does that sound like a good deal? No, man, that sucks.
I want to be the GP.
No, you do and you don't. But, the way we put our deals together is I get paid more if I make you more. So the better you do, the more I make. Well, who's paying attention to the bottom line? The guy that's getting 30% regardless, or me? I'm watching every single deal. We've got a deal right now that we're running through the lease up on. We're supposed to get $1,535 a door for rent. We're at $16 or $1,638 a door. Why? Because I make more money if I get more rent for you, right? Those are the kind of people you want running your deals, not anybody that took a $2,500 class. You want somebody that's got some experience.
How do you know if that's who you're dealing with?
A lot of that is you have to be able to understand the basics of a deal. If somebody's buying it at a cap rate of a 5, and they say they're selling it at a cap rate of anything lower than a 5, they're an idiot. You got to figure on you're buying it at a 5 and you're selling it at a 6. Why? Because markets change. We're in the middle of a great opportunity. Well, if you watch the news, man, you think real estate is absolutely imploding. And for some people it is because they didn't do it properly.
So walk me through how to do it properly, just basics.
You've got to look at it in your cap rate, which is a capitalization rate that you're planning to make the money. And the higher the cap rate, the more return you're getting, right? So to give you an example, we've got a building that does $1 million a year, right? And you want a 10 cap, and I'll take a 5 cap. Well, that means I'm going to pay twice as much for the building as you are because the cash flow out of the building doesn't change. So I'm willing to take a 5% return, which is a 5% capitalization rate. You want a 10% return, so you're looking for different projects, right? If you're looking at something and somebody's saying that, hey, I'm buying this at a 5 cap and we're going to turn it into a 4 cap, that'd be great. And we've done that, but nobody should ever plan on that, right? The other side of it is you want to have somebody that's got actual money in the game. It's easy to sell somebody else's stuff, and it's also easy to toss the keys back at the bank when you've got no dough in it. If I've got nothing in it, it's just your money, I'm not going to fight near as hard, man. But if I've got $500,000 of my money in with $9.5 million of everybody else's money, I'm going to work like hell to save my money too. So you want to look at those kinds of things. If they're not doing that, I wouldn't deal with them.
So you say you always put 5% in?
I always put 5% of the capital in every single deal, and it's not earned.
But do you always raise enough? Because what if you were $1 million short? Would you sometimes throw the $1 million?
I've got deals that I'm 15% in because I needed more tax benefits that particular time, so I put more capital in. But I've got one deal right now where I am the largest investor just because I needed to deploy capital. Because I don't like paying taxes. So my tax bill is...
The next time you're in that position, I definitely want in on that deal.
Okay, I'll call you.
Yeah, because like if most of it's yours, now I'm really in.
Yeah.
Because you ain't putting your money into nothing stupid.
No. Well,
And that's my only fear is like I throw somebody money and it's like, Brad, you didn't read the contract. Dude, you didn't understand. That's the wrong location. And the guy you put the money in with freaking, it was full of shit. Well,
Yeah.
he knew more than I did.
Yeah, but I think there's the thing of track record, right? Look, Brett, I lost everything in '08. I was living in a truck stop. I've learned those lessons the hard way. I had a 7,000 square foot house I had to move out of.
Why?
Because I got in over my head. I put all my capital into a deal that I couldn't build my way out of. I did a big subdivision and I had every single lot. I had an option on it. It was ready to go. It was golden, and the market crashed, and the bank had to sell the lots at half of what we had into them. Well, I had everything I had tied up in one deal, and I had no way to go vertical and build out of it.
Yeah, but it was worth half. Why did you lose it all?
Because when you can't pay the bank and there's 70% of it, they lose money too, so they take it, right?
Oh, so you lost all of yours, and they only lost 20% of theirs.
No, they lost 30% of theirs, and I lost all of mine.
Why do they get that position?
Well, bank always takes first position when they come in and do a deal, right? So if you're bringing the bank in, and let's just say we're doing a $10 million deal, bank's going to come in for $7 million, we're going to come in for $3 million. The bank's going to take first position, right? So if we sell
it's worth $5 million, they get it.
They get the $5 million, they lose $2 million, we lose $3 million, right? But here's the beauty about real estate is
that's why you always got to be the bank.
Well, I don't know, man. The bank's willing to loan me money at 5%. Are you? You going to loan me money for 5%?
Sure.
For 30 years?
If I had the bank's money, because the bank's money's everybody else's money. It's not even their money.
Well, the bank's is fractionalized.
They're fractionalized. Those some bitches don't even have to have the money.
Right.
They're working off freaking digital credits.
100%. But unless you and I go out and start a bank, which I don't have any interest in doing, there's a place for them. They take first position, but you've always got to have 1 or 2 or 3 other plans. We've always got plan A, B, C, and D. I'm in the process right now of remodeling a building that I bought for $5.5 million that I had planned to tear down. Well, interest rates shot up. They built a bunch more apartments just down the road from me, oversupplied that particular market. So I decided, you know what, I'm going to pivot on this. There's a business inside of here. It's an absolute gold mine. It's a freaking aquarium. You been to an aquarium lately? Those things print money, But they were sitting there needing a huge, massive remodel and expansion. And so I came in with the capital. We're doing that deal, and I'm not tearing down the building. Well, if I'd have paid what the building was completely worth, I'd be way upside down in that thing. But I'm into the building for about $2 million on 40,000 square feet. I couldn't even begin to build the shell for that because of the way that we buy things. So you've always got to make sure you've got a backup plan. You've always got to make sure that if this doesn't work, or if this takes longer, or if other things happen, what are my contingency plans? That's another thing you got to ask people. If you don't have a contingency plan, if everything's got to go perfect for me to make my money, run. Because that's not life. Nothing in your life's gone perfect. It goes good, but it's never perfect.
So you were over leveraged in 2008.
Yeah.
And what'd you do? Like, what happened? How much money did you lose?
Well, I lost about $4.5 million.
Like liquidity, cash.
It was 100% cash. And I had a company. I had about 45 employees, had to sell all the equipment, had to go reinvent myself. That was 2009 by the time all that had happened. And by the end of 2013, I'd had 2 neck surgeries. I'd broken 3 ribs. I'd blown out my knee. I'd had back surgery. I just ran into it was just a string of rotten luck. But this was back when doctors would give you whatever you wanted for pills. And I'm sitting in my chair. I can't even take care of my kids because I'm strung out and I'm nothing. I'm living in a $1,500 shit box. I got nowhere to go. And I went in and I had my back surgery, and I haven't taken a hydrocodone since. And I've literally dug myself back out But because I knew the principles of what to do, I knew how to make myself important to important people. I went and built a trucking company. I sold that, took that money, went back into real estate in 15. And we currently have about $140 million under management right now of assets that we own.
What do you think the initial lump sum of somebody to get into real estate would be?
You know, depending. I mean, time is your friend in real estate, right? If that property's appreciating at 3 to 5% a year, obviously, if you're 25 and you've got 50 grand, that's a great way to start, because real estate done right isn't a full-time job. If you're building and managing, that's great. Most investors get involved and they try to do all those steps. You should get somebody in that does property management, because they're going to do a better job than you. They've got access to people that are going to hang that for $2,000 instead of $6,000, right? They know those people. And so you're able to put money into real estate all along life's journey, and you're able to lower your taxes substantially by doing that. And when you're able to do that, you're really able to create a money machine that doesn't need you to run it. How long is this thing going to run if you take off?
It'll run a while.
Real estate runs forever, right? If you've got the right people in place, it'll run forever, right? Because we're always going to need housing. We're always going to need places to conduct business. And that's the beauty of that, because you're not having to be there 24/7, coming up with new strategies, coming up with new things, doing new things. You've got people moving in, you got people paying rent, you got people moving out, you got new people moving in.
Yeah, it makes sense. Again, I've been thinking and hesitating for years. If I'd have just got in when I should have got in, it was right around, I'd say 2008.
Yeah. 2009 would have been an amazing time to start buying property.
Well, right before 2008 was the best time, actually, in my minimal knowledge, because I still remember I just bought a house with my first wife.
Mm-hmm.
This company was just getting started, right? I think it was about 2000. I don't remember, but the houses were going like this, and like this, and like this. It was ridiculous what was happening.
Yeah.
So anyway, me and my wife get a divorce. I give her the house. We only bought it for like $180.
Right.
Next thing you know, I turn around, it's worth like $300.
Right.
I move into a rental, nice little rental, little track home, but nice little rental. The guy says, if you want to buy it, I'd be happy to sell it to you. I'm like, oh yeah, this is cool, man. I'll buy it. How much is it? He said, he'll take $165. I said, oh shit, $165. You crazy shit. Let me think about it. A month or two later, I'm like, the housing was going up. I don't know what year it was. Wasn't it right before 2008?
Yeah. I mean, housing was going fantastic from 4 to 8.
Ridiculous.
Yeah.
So by the time I said, okay, I'll buy it, he said, no, I want $240. I said, screw you. You just said frickin', he said, no, now it's $240. I said, screw you. Waited another 3-6 months. It was just like,
yeah.
And I said, okay, I'll take it for $240. He said, no, now I want $3 something.
I know people like that.
It was ridiculous, bro, what the value of houses were doing.
Yeah.
I should have got in then.
Well, but
that's when every stripper here owned 8 houses.
But then the reality of 08 happened and it went back to 160. In fact, it went to 120, 130.
I didn't ever see that part.
Vegas had a 56% depression in prices from the peak in 08 to where it wound up in 11. So
don't you think that'll happen again?
The problem that happened in 08 was we had a very even supply and demand, right? So houses were flying off the shelves. That was great. And there was buyers. But when the buyers stopped, there was a boatload of houses. Where we're having a problem right now is interest rates are high. So what somebody could have bought a $450,000 house for in 2020, 2021, that house it's about 8% more now. It's appreciated some. It's not gone crazy. It's worth another $35,000. But the payment that they were going to get in 21 was about $1,800. Now that payment's $3,800. My apartments are renting for $2,500. They're the same size as the house. Some of my townhomes are 1,560 square feet. That house would cost you $3,800 a month, and my rent's $24. So I've got a long way to go to catch a house. That's why if interest rates don't come off, you're going to see things slow down. But it doesn't. It's just like we were talking about before. Doesn't mean the rich aren't still buying. So BlackRock's scooping up houses left and right. I mean, there's
they don't care about interest rates.
They don't care about interest rates. They've got capital to deploy. They are the bank, but they know you need a house. They know everybody needs a house, and people will pay for that. We have about a 4.5 million house shortage in America right now. That ain't going to fix itself. We can only build about 1.5 million houses a year, and we need 1 million. So it means it's going to take 8 or 9 years till we have a supply that is equal to or greater. And until that happens, you're going to have a constant demand for it.
What about when they drop the interest rates, which I think is going to be in the next couple months?
Yeah, I think Wall Street's betting 82% that Powell drops rates in September, right?
This month.
Yeah. So if that happens, then I think he's going to ease into it, because if he drops them fast like he did going into COVID, you're going to see prices take off again. And I think that if they do it right, which I know we're talking about the government doing it right. I mean, that's a long shot. But if they ease into it over the next 18 months, they'll be able to ramp up supply at the same time they're bringing prices down, so that it doesn't shoot through the roof. For every 1% that interest rates come down, there's 4 million people in America that qualify for a loan. For every 1% it comes down. So if they'll do that slowly, a quarter point here, quarter point here, quarter point here, they'll be able to ramp up supply and keep that supply taking care of, hey, these are the people that qualify now. Oh, look, we've got a new group to qualify. We've got a new group. So
you think they're smart enough to do that?
I think that the current dynamic that's going on between Trump and Powell is going to make it go as slow as possible. They're not exactly friendly.
Because if it drops massive, the house you're sitting in is going to shoot back up. All the homeowners are going to be happier than shit, and then your payment's still $3,800 because the interest rate went down, but the price went up.
But the other side of that, Brad, is when your interest rate comes down from 6 to 3%, you go from putting of that $3,800, you go from putting about $250 toward the principal to putting about $1,100 toward the principal. So you're getting ahead of that mortgage a lot quicker. And so when you're
only if you refinance, because if you signed up at 6%, you're still at 6%.
Yeah, but nobody's going to hold that. I mean, you go refinance as soon as rates drop. I mean,
so when rates drop, get in the mortgage business.
That wouldn't be a bad one. That'd be a good way to make some quick money, because as rates drop, I remember in 2004, I built the office building for the largest builder in the Idaho area, and he was doing about 1,800 houses a year. And interest rates were ticking down 0.1%. And I was talking with him and I said, man, you must love this. Rates are down 0.1%. More people are qualifying. He said, man, I absolutely hate this. He said, people are waiting until it hits absolute bottom to buy because they think they're going to save $20 on their mortgage. It's going to be such a better day for them. And he says, but when rates start going up, the houses fly off the shelf because the FOMO kicks in and they don't want to miss and they don't want to pay more. But when it starts going down, but I think where we're at now, there's a lot of people that could have bought 2 years ago that had that taken away from them when interest rates went up. When rates start coming down, they're going to start seeing that opportunity again, and they're not going to wait. They're going to finance at 5, 4.5, 4.75, and then maybe if it drops, it makes sense for them to do it again.
I don't think it'll ever drop below 3.
I don't think we'll see it back down under 4 at all. That was
ever again.
No, I don't.
That was a dream.
That was. And those people, they say that there's 75 million Americans that are locked in at that rate. They can't sell their house and move across the street to the exact same house and get anywhere close to the same mortgage payment, right?
So they're stuck.
So they might as well make that a rental and then buy something they can afford and use that other income to help offset it.
Or do you have any locked in rates like that?
We do. Yeah. I've got a deal in Texas that we have 3.75 on.
How low did it get?
That's about the lowest that I saw. I knew of guys that were doing multifamily deals at 3.5, 3.25. You know, we sold a deal to Kennedy Wilson, their publicly traded company. We sold them 180 units for $64 million, and they were getting something around right at about 3.25.
When you sell it to them, do you get paid all upfront cash money?
Oh yeah. That was a good day to go to the title company.
Yeah, how
You know, it's funny though,
that?
the check didn't weigh anymore, but it was a big one.
So if people are listening, they're like, dude, I want to invest with this guy. Do you have the advantage because you can build something rather than have to go find something?
Absolutely. So I'll give you, everybody talks about value add, right? You buy an apartment complex, it needs a coat of paint, it needs new deck chairs by the pool. They're going to revamp the clubhouse and they're going to raise the rents $200. And that's going to take this $50 million asset to $70 million. Well, I built that $50 million asset for 37. I made that money when I put the first tenants in. We are the original value add. So we create value. The day we open the doors, we've created value, right? Because and we're not giving that up. So when somebody comes in and they buy a $50 million asset and they do all these things and they add value to it, the goal is in that period of time, in the first 2 or 3 years, to do a refinance and pull that cash out. Mm-hmm. Well, we're doing the same thing, but quicker, and we're getting more of the investor's money out, but they're still owners. Because you got into the deal and you're 20% of this deal and you've got $1 million in here and we get a refinance and I get you $800,000 back, you're still getting 20% of the cash flow coming out the other end of this deal. We've just involved the bank as our major partner and we've got our cash back out to go do it again, right? So,
well, didn't you get the bank involved in the first place?
Yeah, we did. But then as the rents go up, we've got the ability, see, rents determine the value, right? So we were talking about that $1 million in NOI, net operating income. We've got that to pay the bank. Well, if we're getting a 3%, 4% growth on that every year, we're chunking on that pretty quick. And now 3 years down the road, we're able to borrow more money. Plus we have all the equity we built into it, right? So we're going to get to that refinance and pull cash out. And when you're pulling cash out, that's a tax-free event. That's not profit. According to the IRS, it's still money back to you that now you can go in and say, hey, let's do another one, and you're still using proceeds from your first deal, right? Yeah. And that's where you can really multiply your returns.
So there's people listening with some money in the bank. They aren't ever going to go learn what you've learned. They're not ever going to actually do it. They're going to throw money in with somebody, right? That's what they're going to do.
Yeah.
And what type of return would these people be able to expect?
So there's two returns that we provide. One is the cash on cash, right? So that's your $160 a month that you get, right? We typically target a 6 to a 7% cash on cash return.
6% of what I gave you?
Yeah.
So let's say I gave you $100,000.
Right.
You would give me back how much?
About $6,000 a year, right? So
$500 a month.
$500 a month. But on top of that, you've got the tax benefits of the bonus depreciation when you got in. The majority of that money comes when we sell the product in 5 to 7 years. Now, along that journey, we're going to have a cash out event that's going to get you at least 60% of your capital back. So you put in 100, I'm going to give you back 60 in year 3, right? When we hit year 3, you're going to take that 60 and you're going to redeploy it. You're still getting your $5,000 a month. And now you've got 60 over here doing it again. Well, hopefully you've been smart enough in that 3 years to save another $40,000 so you can put another 100 over here. Take advantage of those tax benefits, deploy that capital. Now you've got $10,000 a month coming in. And when we sell, the typical return for our investors is about a 25% IRR. So 25% a year. So if we've been doing business for 4 years, you're getting your hundy back plus a hundy, right? So if we've been in business for 8 years, you should be getting back a lot more than that.
Who decides when you sell? You?
I do, yeah. Because I've had people want money back now. They've got some sort of life event going on. That's fine, but that's not when you sell. You sell when you're ready. You sell when the market's ready. You sell when the asset's ready, right?
Now, what happens if the market tanks and now you're sitting there screwed? You just operate on the cash flow?
Correct. I mean, look, we're in a market right now. You wouldn't want to sell right now because the interest rates that you're going to incur aren't going to be beneficial for you, right? And the interest rate also determines how much the bank's going to loan you. So we may be looking at an asset that we could have bought in 21 that we would have needed $3 million for. Well, today to buy the same asset with interest rates where they're at, we need $5 million, but we're still only getting the same return. So now we're getting less return on our money. That's not what you want, right?
No, you just stay put.
If you wait 18 months, rates come down, rents have gone up. Now we're back in the money. We can buy that asset for $3 million down, and we're going to be in a great spot, right? So those are some of the things that timing is a lot of what happens in real estate. And it's having the knowledge of when to sell and when not to, when to buy and when not to. You know, I got a buddy of mine that's got about $2 billion worth of real estate, and he didn't buy anything in 21. Didn't buy anything in 20. The prices were too high. I wasn't buying any buildings, but I sure was selling them, you know?
Well, you got the advantage, I think, because you get to build them, and you can't buy them cheaper than you can build them.
No. So I'm getting the best returns. I'm getting a better return than somebody that's buying, because in real estate, the minute the tenant's in there, it's now converted from a cost to a cash flow calculation. And, you know, I mean, I'll just be honest with you. That apartment complex we sold for $64 million, we built for 37.
How much is it worth today?
68.
You technically shouldn't have sold it.
3 years. But look at what we did with the money in between here and there.
What did you do?
About $30 million worth of deployment of capital that we partnered with the bank at 60%.
Because a billionaire buddy of mine, who since died, but he said, Brad, the trick is to never sell.
True. That's the best way to do it, right?
He said, never sell. I'm like, how am I ever going to get my money? He goes,
you borrow it.
Yeah. But you never sell it. I said, what do you mean? He said, I've never seen anyone who sold something 10 years later that didn't wish they had it back.
Well, and that could be true, but I'll tell you what, when I did that deal with that family office and I partnered with them and I built that apartment complex, I had my house. It's all I owned. And I was building this apartment complex. We've now got $140 million under management. So sometimes there's a good time to sell, because what you can do with that capital in redeployment is better for you.
Just raise more capital.
That's another option. But at the time I was selling it, I hadn't raised $1 in capital.
Well, how do you start raising capital? How would I leverage my audience and raise capital? If I said, hey guys, listen, I'm going to go into business with my man here. If anybody wants in, send me money. What do I got to set up in order to start syndicating?
The same way I did it. You have a resume, right? You are known for making things happen. You are known for building businesses. You are known for making cash flow happen.
Yes.
Right? Okay. So people are going to invest with you based on that resume. I had the same resume. I had built a lot of stuff. I'd built police stations. I'd built fire stations. I'd built medical facilities. I'd built schools. People knew I could build it. And when people began to see that they could partner and be a part of that, they started to believe that, and we were able to produce the returns, right? But you have to have some sort of resume of credibility, right? Well, you've got that. I had that.
Not in real estate.
But you have it in other areas.
Yeah, but I'm not raising money for other things. I want to raise money for real estate.
Right. But you're not out there telling people, hey guys, I'm going to open up the Bradley home building division and we're going to be building single family homes. Nobody's going to invest in that. But if you say, hey, I have done my research as a business guy and I've done a deep dive on these guys over here and they're legit and we're going to invest with them, you're going to have a line out the door. That's exactly how you leverage your resume to do these things that I'm doing, right? So in 2019, I was working with this family office and they decided they were done. There's 8 brothers and sisters, and they decided, you know what? We're going to split up all the money. We're not doing a family office anymore. We all want our cash and we're going to leave. So they did that, and I didn't have another $19 million. So I went out at that point and started raising capital. In my first deal, I raised $1.8 million. It took me 5 months, right? Well, now we consistently raise between 12 and 17 million a year, just pretty easily, right? Plus we keep 90%, 98% of our people, they stay with us. So we're continuing to expand that capital. And we've done that since 19.
Well, why wouldn't anyone stay with you if you're paying them on average? You say 25%?
25% is our average deal. Yeah.
Dude, everyone will give you their money if 25%.
As long as we continue to do what we're doing, which is why our focus is on doing it right.
What's your company called?
Phoenix Commercial Construction, and then Shannon Robnet Industries has the property management company and the fundraising and all that other stuff.
Yeah, but if someone's listening going, dude, I want to throw this guy a little dough. Number one, what's your minimum?
50.
So someone can throw you 50 G's that's listening to this podcast, and you're saying a year later they would have got 6% cash on cash return.
Typically, yep.
And
typically our
4
investments,
years, they'd get a hundy.
Yeah, 4 to 7 years is our typical investment cycle, right? Because in that time period, we've had enough time to build, grow, refinance, and then usually around that 7-year mark is where we'd look to sell, do a 1031 into something bigger, something better that's going to continue to compound that in a tax-advantaged way.
Well, no one's going to give you all their money. So
no, I would never take all
obviously.
their money.
So like they'd be a fool if they did that. They but if I have 50 grand laying around and I've been thinking, shit, maybe I need to buy a house. It sounds like it would be smarter to give you the 50 grand and let you turn it for the next 3-4 years. I get paid every month. I get tax appreciation as if I actually did the job myself. Because a lot of companies don't do that. They keep it all themselves.
Correct. No.
So you're getting tax depreciation. You're getting, your cash back in the first, you say what, year?
No, typically that's about 2.5, 3 years is when cash comes back, right?
So if I gave you 50 G's, a couple of years later, I'll get my 50 back, but I still own the unit.
You get 60, usually 60% of that comes back. So you get about 30, 35. But Brad, I'm going to be right there with you with another deal. You're going to want to do this one too, man. I mean, I'm not a fool, right? My job is to keep your money moving. My job is to keep your money growing. So when people come in with us, what they're really wanting to do is build to that point that 50 grand is now gone and made friends. And now they've got $500,000. Now they've got $1 million. You know, I hear people come in all the time and they go, dude, I just want cash flow. Okay. Take the number you have. Think about it. Can you live on a 6% return on that cash? No, I can't. Okay, so we need your money to make money so that we can continue to deploy it so that it turns into that amount of money.
Yeah.
You know?
What about equity? Do I have my name on shit?
No. I'm the only one that's involved in any of the lending. So when we set things up, we have a general partner that takes care of all the financing, signs all the docs, does all that kind of stuff. The limited partners sit in a completely separate company outside of that. So they are limited because they don't have to sign anything and they don't have any liability. So if the building falls down and kills somebody, they don't have any liability, no exposure whatsoever to any of that. Makes it simple.
But what about like if I got $5 million with you, if I had it in a piece of property with my name on the deed, I can get a line of credit on that $5 million equity.
Sure. When you're with us, we're going to deploy that capital in 2 to 3 years. We're going to refinance. We're going to get that back. You can either take it at that time or you can redeploy it in another project we have, right? So yeah, you could go, if you had a $5 million cash paid for piece of property, I wouldn't recommend it when you could take that money and put it into, hell, you can go buy VOO and get an 8% return and you get a 5.5% mortgage. Why would you do that? Right? Go put it in VOO and mortgage the house. There's a way that interest makes sense, right? Think of it this way. There's good debt and there's bad debt, right? Good debt is debt that pays you.
Not according to Dave Ramsey.
Don't get me started on that guy, man. Dude, I've watched good people do horrible financial things based on having everything paid for. You know what?
I'm not a fan of his philosophy. I was at his, it wasn't his party, but I was at a party where we were in one of his properties. Mm-hmm. So I got a chance to talk to him and I said, dude, tell the truth. I said, bro, you ain't got a credit card in your wallet. He said, nope. I said, Dave, come on, dude, you're worth freaking at least $100 million. You ain't got a credit card in your pocket now? Like, how do you rent cars? How do you do? He goes, debit card.
Yeah.
And I didn't check his wallet, but he said, no, I do not. Number one, I tell everyone not to, so I'm not going to go out and do it.
And I understand when that's how you built your brand.
But but whatever he did is working for him because that dude's loaded like a mofo.
Yeah, but that dude didn't build it. He created a brand. His brand is what's worth money, right? I mean, that's what he did. That's where his money comes from. It doesn't come from really great real estate decisions and really great financial decisions. It came from building a brand. He makes his money selling books. He doesn't make his money selling real estate.
Yeah, and I don't understand. I mean, again, I told him, I said, dude, there's good debt and there's bad debt. And,
Yeah.
I understand dipshits getting caught in credit card hell and
100%.
not being able to get out of it. And so that's a good rule for certain people.
It is.
I said, but if the bank would loan me $100 million right now for zero interest, $0, but it's debt, wouldn't it be? He goes, yeah. And I said, and you wouldn't take that $100 million if you knew you could go make $200 million on the $100 million and then pay back the $100 million. He goes, I wouldn't take debt.
Yeah.
And I said, well, that's where we disagree
100%.
because there is good debt and and you'd be a fool not to. Matter of fact, I keep telling people, anybody want to loan me money? I'll take it all. Why?
Yeah.
Well, as long as I can deploy it for more than it costs me to take it, I'm going to take it.
Absolutely.
You give me $100 million at 5% and I know I can take that $100 million and make 10%, I'll take your $100 million.
Absolutely.
And I'll just keep the 5 extra.
But when you're Dave Ramsey, the minute you take that debt, your whole brand collapses, which is how you got your first $100 million. That's a little bit more of a gamble, right?
Yeah.
I look at it this way, that it's got to do exactly what you said. And this is why people understand people that know how to make money. They know who you are because of what you put together, right? And when they see that you can do that, they know that, look, you and I were talking about this earlier. Making money's not hard. It's knowing what to do with it so that it does something that doesn't need your time right now. The thing that you're short on every day isn't money. The thing you're short on is time. You could work 24 hours a day and still not get caught up. You've got to find a way for your money to go make money for you while you go do the next thing that's going to make more money. And that's what real estate does for everybody.
That's why everybody listening, if you're smart, you go vet this dude and you go, hey, this dude knows what the hell he's talking about. Let me throw him some money while I'm busy making more money and act like that money doesn't exist, because that's what I would do.
Right.
If I give you money, I'm acting like it's just gone. And you know what? I've done it. I've done it in Bitcoin. I've done it in, Ethereum, where, let me get X amount of Bitcoin. And I just act like it ain't there. And dude, it's paid off.
Yeah.
But again, I can borrow against my Bitcoin. Once I hand it to you, now it's yours and not mine.
But we're leveraging it. We're both leveraging it because I'm taking your 100 and I'm tying up $400,000 worth of real estate with that 100. So we're leveraging that. And as that 400 grows at 3% versus your 100, you go buy that $5 million piece of land and it grows at 3%. You're going to make $150,000 a year on just that. But if you leverage that and you get a $20 million piece of land that's appreciating at 3%, you're making a lot more money. And that's the whole point, right? So when you bring it to me, I sign for the leverage. You're not signing for the leverage, but you're participating in the leveraged asset.
Yeah. Well, that's mighty nice of you.
Well, it's the least I could do.
Yeah. Now, last question. Damn it. See, this is why I interrupt, because if I have questions and I don't, I forget them. What the hell were you just saying? Because it was based on that.
Leverage.
Well, again, I'm trying to think, what would I be thinking listening to this? Like, I know you know your shit. I'm going to go look you up because I might have a little cash. And you know what? I've been looking for someone besides the ones that are out there that I do get the tax appreciation. I do get the equal leverage. The guy does know what he's doing, and you're building them, which means you're buying them cheaper than anyone else is buying them.
Right.
Because rumor has it, some of those guys, they'll just go pay whatever price because they don't care what the damn price is. It ain't their money. All they care about is the cash flow.
Right.
Give me the cash flow.
Well, and they make money when they do the deal. See, they get
make
paid
money
up
to
front.
do the deal. They make money to manage the deal. They make money on everything.
And if they've got no money in it, they're handing them back to the banks.
Yeah. Well, again, there's people, I know of people that they've called me. They're like, Brad, how come you don't do it? I'll throw some money in it. Well, because I don't make claims that I don't know for sure. And that's why people will give me money, because they know if I ever say, give me your money and I'll make you some money, they will send me money. Why? Because I'm not saying it unless I know for sure that that's the case.
And I'm in the same boat. I wouldn't be taking it because look, there's 3 levels of money. There's God's money, there's investors' money, and there's my money, right? And you don't mess with the top 2, because to me, that's what continues to keep my business expanding. I can stay right where I'm at with what I got.
Yeah.
But if I start dicking over my investors, I'm not going to get any more.
Well, I don't think you would do it on purpose.
No.
But I throw you my money. It's now your money. I wish you would figure out how to get me in where I'm with you, like GP level or something. Because if you want, you could go get a loan on that if you wanted.
Absolutely.
So what if I, for example, let's say I gave you a big chunk. Hey, here's 10 million. You just go do one project. So it's me and you basically, because I put up all the money. You got 5%.
We'd have a totally different arrangement, Brad.
But you got 5% in the deal. Now you could literally go borrow that, because if I put $10 million down, that's equity, is it not?
Yes, absolutely.
So now you could go do that. Now I gave you 10 million. You go borrow
Another
6
30
million against it. Well, you can't borrow 3 times the equity. You borrow 80% of it or 60% of it.
Yeah. So I'd go, if I had 10 million in equity, I'd be able to get another 30 million in loans to go with that. We'd have $40 million asset.
Yeah, but what I'm saying is you could borrow, let's say you could borrow 60% against that equity.
Okay.
So you got 6 million for sure.
Okay.
Now you got that 6 million. I don't.
Right.
So now you take that 6 million, you go buy yourself another property. Do I automatically get that property too?
That's correct. That's how the expansion goes. That's why.
So if you take equity out of this property, I'm rolling wherever that equity went.
Absolutely.
Automatically.
You have a choice. You can get off the train if you want to. Nobody likes to.
Well, I wouldn't either.
Yeah.
But my point is because to me, it's like, okay, let's say I got $10 million. I can borrow $6 million against it. And now I can go get another property. And now I got double the property for the same 10 million.
That's now growing at 3 to 5% a year. Then another 3 years.
Plus tax depreciation.
That's right. Then we're taking another loan. We're expanding that loan in another 3 years. We're pulling more cash out. I mean, that's the beauty of, and that's what your billionaire buddy was saying. Don't sell it. Keep mortgaging it to keep that equity coming back out to you to expand.
Yeah.
You know, when you look at what Elon did when he bought Twitter, he just leveraged his stocks. He got a loan against his stocks to buy Twitter. You know, he still owns the stock and he owns Twitter, right? So when you look at the way that that's done, that's the way that that's the good money. Those are the good loans. And I think it's paid off very, very handsomely for Elon on that acquisition.
Well, all I can say is this. You definitely know your shit.
After 35 years, that's a compliment, though.
Okay, so last question. My man Grant, I asked one day, because I have the inclination to end up developing too, because to me it's like, dude, if you build it, you wouldn't build it if you could buy it for half as much. So if you're developing the damn property, you're doing it cheaper than someone can buy it because I'm developing it and he's the one buying it from me. And the only reason I'd sell it to him is to make my damn money back plus some. Mm-hmm. So the developer's building it cheaper than you can buy it. Otherwise, they wouldn't be developing.
100%.
Okay. So if you're developing the shit, I'm getting the best deal on the damn multifamily unit anyway because I'm with you, right?
Absolutely.
So that means I'm a developer now.
Right.
So I asked Grant, dude, I don't understand. I mean, I understand because he's taught me a lot.
Yeah.
And, I always assumed he was trying to get my damn money. So, but he was telling me how it worked and I'm like listening. And then I said, why don't you develop? Why don't you just, you got enough money now where shit, you don't need to raise money. You could use your own. You don't have to share all this damn profit and you can develop it. And he said, I want it to cash flow day one.
Right.
So how come you don't want it to cash flow day one? Why are you willing to take that year and a half or 2 years to build the damn thing when he's not? Like, are you smarter than him or are you dumber than him?
I wouldn't say that I'm smarter than him, and I wouldn't say that I'm dumber than him. I would say that I have a different business model. I would rather build in a 20% equity margin into every single deal that he doesn't have. That in this market, if he was buying stuff at the top of the market, I can't think it's doing phenomenal right now. Right?
Well, again, nobody knew that shit was going to go down.
And I'd like to get nobody knows when that shit's going to go down. And so if I've got a 15 to 20% edge over the next guy, that means I can weather the storm a little bit better. And when you lose everything, you tend to want to weather the storm the next time, because that ain't a fun way to come up a second time. You're 34 years old and you're reinventing yourself and you got nothing and you're used to having something. Everything that I built the first time, I built in half the time the second time. And if I had to do it a third time, I'd build it in 2 years. But that's because I know the system. And because I want that extra margin of safety in there. Plus, I can build better in emerging markets. Look at what's happened to Vegas, right? This area has exploded. Where you would have built apartments 10 years ago, is that still the best part of town? Probably not. You want to be in the best part of town. You want those A-class apartments because they cash flow.
So how come
better.
he doesn't want to develop?
I couldn't answer that for you, man. I mean, that's a whole different team, right? That's a whole different skill set, right? His skill set is raising money and, doing what he does. He's got a team that does that. Do you want to add the complexity of making a 2-year project out of deploying $60 million? I would,
because now I know I'm getting it 20% cheaper than he's buying it for.
Right.
And
he's just buying 3 of them.
Well, it doesn't matter.
Right.
I'll build 3 of them.
Sure.
At the end of the day, I think for some reason, and again, I can't figure out why yet, I just have sneaky suspicion that it's better to build it.
I know it's better to build it because of what you could build it for.
Yeah. And I'm gonna one day get you, maybe Grant, and another guy to argue, and let's figure this out. Cause I want to know, I have a feeling developing, if you can afford it, cause maybe, he don't have the team. He doesn't have the knowledge. That's why. Oh, okay. That makes sense. But from a, if he could build it, cause you can build it.
Right.
And he ain't just saying, well, Brad, I ain't building it because I don't know what the fuck I'm doing. That makes sense.
Right.
But I don't know if he'd say that. He told me, because I want it to cash flow from day one. I don't want to have my money wait for 2 years. Well, again, it's then why do you?
Well, we're making 20% in that 2 years, right? So he's getting a 5% cash on cash. Here's the other thing. I don't have to bid for land, right? I go out, I look at the land, I do my due diligence, I get my entitlements on it. There's not 20 people trying to buy this piece of land. Every apartment Grant has bought in the last 10 years, he was one of 30 to 50. Just ask him, he'll tell you.
That's what drives the price up.
It drives the price up. So now you've got extra work, because where you were wanting a 6% cash on cash return, you wound up, by the time you bought it, you're down at 3. So now you got to work twice as hard. You got to be pushing the market, and you may or may not get it. Yeah.
Again, I don't claim to know everything, but I have a sneaky suspicion the developing is where I'm going to lean towards. Why? Well, because dude, you can build it cheaper, and that puts you in the best possible situation to where I'll build a $50 million unit and then sell it to him for 58,
72,
or better yet, not sell it at all.
Right.
Because if he'd have paid me 58, well, then it's worth 58.
Mm-hmm.
Which means I got $8 million in equity. Why would I sell it? I'll just do what he's going to do. Then I cash flow it.
Absolutely.
So again, I'm going to have to get him on the phone and ask him why. Cause I can't figure out why he wouldn't develop, and it can't be cash flow.
No, you know what? I don't know, but
probably because he doesn't know how. I mean, at the end of the day, dude, you got to know what you're doing in that arena too. Cause let's say I got the money to go build a house. Dude, I'll overpay for that house. I'll forget to frickin' zone it right. I'll find out the foundation's off because I didn't understand what the contractor was doing.
Build it too tall, and you need a zoning variance now for a 64-foot house, all that kind of stuff.
Yeah. So I'll bet you that's probably what it boils down to. Why guys like him just buy, because they can't develop.
Well, and I've got a friend of mine, like I said, he's got a $2 billion portfolio. He builds some, but there's a specific reason why he builds. They're undersupplied markets. Everything else in the market is 30 years old, so he's building new product. He's very specific as to why he buys or builds, but when he does build, he partners with a builder. So now
He has to because he doesn't know how to build.
and he's getting the best deal because the partner is benefiting for every dollar that's saved also.
Yeah.
But he's got to save him the money to get some money.
Makes sense to me, folks. My man, if you want to take a look at that Montana deal.
I'm going to take a look at it on Monday, just like I said.
Yes, sir. And then I'm going to obviously talk to you more offline.
Yeah.
If the bomb squad can help you in any way, tell them now. How can the bomb squad help?
You know, if you want to know where we're at, just go to shannonrobnet.com. You can get a list of projects that we've got going, things that we've got. We've got trainings, we got videos, we got all kinds of stuff there. And love to hear you there. From there, you can get to my calendar, get a 15-minute call. Let's see what we can do to help you.
Podcast is called
The Robnet Real Estate Rundown.
The Robnet Real Estate is all real estate, I assume.
Yep.
Robnet Real Estate Rundown. Go listen to it. Till next time, invest your money, quit blowing it, and keep it real.